The majority of Americans cannot afford to buy a home. That's according to data that came out in 2023, which says that about 6 out of 10 Americans cannot afford to buy a home in this economic environment. Now, that being said, we're not seeing homes in the housing market becoming more affordable. In fact, every time we see a little dip in mortgage rates, you see more and more people want to go out and buy a home, which pushes home prices even higher. This has some people wondering, should I be renting a home? Should I wait out this housing market? Or what should I do? Now, before we jump into that, let's talk about the 4 different factors that are making this housing market so unaffordable. Number 1 is home prices. Number 2 is the implication of higher home valuations. Number 3 are mortgage rates. And number 4 are slowing incomes. Let me show you. Starting with home prices, the median price for a home sold in America today is $467,000. This data is directly from the Federal Reserve Bank, and this data is from the end of 2022. That's the most recent and up-to-date data that we have right now. 12 months ago, the median price of a home sold in America was $423,000. This is just more than a 10% increase in home valuations over a period of 12 months. Now, we have higher home prices, which means you have to pay more money to buy a home, but that also means that when you go to buy a home, your property taxes are also higher because your property taxes are based on the value of the home, which means, yeah, you got to pay more money for the home, but now your annual property taxes are also higher. Not to mention that your home insurance is also more expensive because now you're going to be insuring a more expensive property. More insurance means a higher monthly payment. So you have a higher home price, which is number 1. And the implications of the higher home values are higher property taxes and higher insurance fees, which also brings us now to number 3, mortgage rates. Recently, we've been seeing a little dip in mortgage rates, which is good on one hand because that means that now you can go out and get a mortgage for a lower price, but that also has been pushing up demand to buy a home, which is why we've also been seeing home prices start to rise even more quickly again, because anytime you see mortgage rates drop, more people want to go up and take advantage of these lower mortgage rates, which push mortgage rates higher. But now, if you wanted to buy this home and you can get a 6.5% mortgage and you put down, let's just say 10%, that means you're going to be paying around $26.57 a month just for your mortgage. Now, a year ago, if you bought the same home, let's say it cost $423,000 and you put down 10%, you might have been able to get a mortgage for around 4.5%. Well, that also means you're going to put down a lot less money because in this instance, 10% is $46,700. In this instance, 10% is $42,300. So you would have been able to save some money on the down payment, but if you borrow this money at 4.5%, that means that your mortgage cost would have been around $19.50 a month. You would have saved about $700 a month just on your mortgage payment alone. And then on top of that, you also have your higher property taxes. And then you also have the higher insurance prices here, which is why buying a home has become so much less affordable year after year after year. And then you also have to look at incomes. If the price to buy a home grows by 10%, it's not that big of a deal if your wealth has also grown by 10% or more. Or if the cost to buy a home, your monthly payment has grown, in this instance, by around 30%, and your monthly income has grown by 35%, that's not that big of a deal either. But what we've been seeing happen is, for the last number of years especially, is that people's incomes haven't been growing fast enough to keep up with inflation, which essentially means that the average person is slowly becoming poorer because the price of things, including housing, is growing faster than people's incomes. And if we look into the data in 2022, we saw people's wages grow by around 6.1%, which by itself might look really good. Hey, people's incomes grew by 6.1%, but that didn't even keep up with the CPI, the inflation data. And that definitely didn't keep up with the growth in housing prices. So on one hand, yes, we are seeing people's incomes rise, but they're not rising fast enough to even keep up with inflation, and they're not rising fast enough to keep up with growing home prices and mortgage costs. If you really want to be able to afford to buy a home, there are 3 different things that you need to be able to afford. First, you have to afford the down payment. Number 2, you have to afford the monthly payment. And number 3, you have to afford the move-in costs. When it comes to the down payment, just like everything else, just because you can qualify for something doesn't mean that you can actually afford it. Meaning, just because you can actually buy the home doesn't mean that you should buy the home because you can't afford it. So when it comes to being able to afford the down payment at the very low end, you want to be able to put down at least 10% of the home price. So if you're going to buy a $500,000 home, that means you have to have $50,000 saved up to be able to use as a down payment. That's not $50,000 in your emergency savings fund. That's not $50,000 in your investment account. $50,000 saved up separately to use as your down payment. You don't want to dig into your retirement fund or your investment fund to go out and buy your home. This is money that you put aside to buy your home. That's separate. So 10% for the down payment. Then for the monthly payment, I like to follow Dave Ramsey's tip on this. Dave Ramsey says that you do not want your monthly payment to be more than 25% of your take-home pay from your job. So if you're taking home $10,000 a month after taxes, the max that you can pay is $2,500 a month for your mortgage. Now I know that's a little bit tight for some people because people want to spend more money on their home, but the reality is if you're spending all of your money on your mortgage, you're not going to have money to put towards your actual investments that will be able to make you even wealthier. These are things like your stock market investments, your real estate investments, investing in other businesses. Those investments can build you way better wealth, way more generational wealth than just the home that you live in, because now these investments can continue to pay you even after you die, versus with your home, you got to keep paying your property taxes without income coming in from your home. When you have a rental property, yeah, you got to pay your property taxes, but you have tenants that are paying you rent, which will cover property taxes. When you own these types of businesses and stocks, they can pay you with cash flow from dividends, and they can continue to operate without you having to do things, versus with the home that you live in, yeah, if you pay it off, you don't got a mortgage, but you still have to maintain it and everything else, versus everything else, your generational wealth from your stocks and your real estate and your businesses can continue to grow because you're buying these things for the sole purpose of making money, versus with your home, yeah, you're buying it to make money, but you're really buying it to make memories. That's the number one reason why you're buying this, versus everything else you're buying for the sole purpose of making money. So if you want to be able to afford the monthly payment, it should not be more than 25% of your take-home pay. And then you got to be able to afford the move-in costs. And this one is very much overlooked. Your moving costs are number one. How much is it going to cost to get a mover to move your stuff into the home? Number two, how much rent you're going to spend in renovations? Do you got to upgrade the kitchen, the bathroom, the bedrooms, the basement? Number three, what about the appliances? Are you going to be upgrading the appliances with new appliances? Factor that in there. Make sure you have the cash to do that without going into debt to get the new appliances. And number four, what about furniture? If you're going to get new beds, new sofas, new TVs, and all that stuff, how much is that going to cost you, and do you have the money for that right now? If you can afford these three things, you have passed number one, where you can actually afford the home. This is where, as a financially savvy person, you need to understand what impacts the housing market, and one of the biggest factors that will influence which direction the housing market will go is the Federal Reserve Bank. Now, the Federal Reserve Bank is the central bank here in the United States, and while they're called the Federal Reserve Bank, they're not federal, it says so on their website. They're not a reserve, they don't keep cash reserves anywhere, and they're not a bank. You and I can't go there to deposit money. Now, while they're not federal or a reserve or a bank, they do have the ability to impact the housing market, and the way that they do that is by affecting demand. See, the Federal Reserve Bank is in the business of monitoring our monetary policy, aka money. They want to see how much money is out there, and they want to control inflation. And right now, even today, although inflation has come down significantly off its highs, it's a lot higher than where the Federal Reserve Bank wants it to be. The most recent inflation report came in at right around 5%, and the Federal Reserve Bank wants to see inflation at 2%. And the reason why is because when you have such high inflation, it makes the average person poorer because, well, when your wages don't keep up with inflation, that means the price of things are growing faster than your incomes, which makes it harder for the regular person to be able to afford things and food and groceries and rent and vacations. So the reason why you want to keep your eye on the Federal Reserve Bank is because one of the biggest factors in inflation is home prices. In fact, a third of our CPI, which is our big inflation number, is the housing market. Now, they don't look at the housing market directly. They don't look at home prices or rental prices. They look at something called owner's equivalent rent, which is an indirect way of looking at home prices. And essentially what owner's equivalent rent means is that you have people that are calling up homeowners and saying, if you were to rent out your home, What would you rent your home out for? And based off of these numbers, you get what is the owner's equivalent rent. Why did they do it this way? I don't know. Instead of looking at the housing data, they look at the owner's equivalent rent. But this is what they do. So they look at the housing market indirectly through this thing called the owner's equivalent rent, and they include that in the CPI data. So now, we have inflation that is very high. CPI inflation is high. And to bring inflation down, the Federal Reserve Bank needs to cool demand. The reason why they want to cool demand is because when you have a lot of demand for something, if a lot of people want to buy this mug, well, then I can sell this mug for $200 because everybody wants this mug. But if nobody wants this mug, I'm not going to be able to sell it for $200. I might have to sell it for $2. Just like that, when it comes to the housing market, if you have a lot of people that want to buy a home and not that many homes for sale, that means you have a lot of demand, low supply. That pushes home prices up. This is why every time we've seen mortgage rates fall, we've seen everybody want to go out, get a mortgage, buy a home, which pushes home prices up because then you have a bidding war. Everybody wants to buy this few homes for sale. People start bidding against each other to buy this home, which pushes home prices higher. And so in order to cool down this demand, to cool down inflation, the Federal Reserve Bank is working to increase interest rates because higher interest rates cool demand. If, let's just say hypothetically, mortgage rates went to 10% tomorrow, what would happen? Well, you're going to see way less people go out and want to buy a home. That would cool down demand. Because if less people want to go out and buy a home because it's less affordable, then you're going to have less buyers out there. And if less buyers are out there, sellers would be forced to cut the prices of their homes. And then that would help cool down inflation. This is where now you got to understand, if the Fed is trying to cool down inflation, and the way they do that is by cooling down demand, that means they want to cool down the housing market. And they're facing a little bit of a dilemma right now because they've been working to increase interest rates, but we're seeing the mortgage market come down. Why? Because mortgage rates and interest rates are similar, but not always linearly correlated. See, the interest rate that the Federal Reserve Bank sets is called the federal funds rate. This is the interest rate that banks lend money to each other at. You can think of it like the wholesale price of a loan. If a bank has to borrow money at the wholesale price, they will then jack it up and give it to you at the retail price. Like when you go to Costco to buy a shirt, Costco is going to buy the shirt at the wholesale price from the manufacturer. Then they're going to jack up the price and sell it to you at the retail price. Banks work the exact same way. They borrow money at the wholesale price, this federal funds rate. This is the interest rate set by the Federal Reserve Bank. And then they're going to jack up the price and give you your mortgage rate, give you your credit card rate, or whatever the other type of loan that you want. So the Fed sets that wholesale price, but that doesn't determine the actual retail price. The retail price is then going to also be influenced by inflation. Now, this is where things get a little bit complicated because inflation affects the value of the dollar. And just stick with me for a second because I'm going to explain what this means. I know we did a whole deep dive of this in Market Briefs, which is my free financial newsletter, which is why if you haven't joined Market Briefs yet, I highly recommend you do so because every day my team's breaking down what's happening in things like the housing market, the stock market, the global economy, our own economy, inflation, and everything in between. So if you haven't joined Market Briefs, it's a completely free way for you to stay up to date on what's happening, and you can read it in less than 5 minutes every morning. And I'll put the link to how you can join Market Briefs for free down in the description below. But the Federal Reserve Bank and inflation affect now the general interest rate environment because when you have high inflation, that impacts people's view of the dollar. And when people are worried about the dollar, well, that can impact treasury bonds. What does that all mean? Well, the United States government offers the ability for regular people, you and me, to loan money to the government. This is called a treasury bond or a treasury note. And when you loan money to the government will pay you back with interest. Now, this is considered the risk-free investment or the risk-free rate because the government has the ability to always pay back their bills. How? Because they can work with the Federal Reserve Bank who can print money and give the government money. So if you had a money printer that could print an unlimited amount of money, well, yeah, you can go and spend whatever money you want because you have a money printer on your side. This is why the government is called that risk-free investment when you loan money to the government because they can always pay their bills. So now, when you have high inflation, people are worried about the dollar. And when people are worried about the dollar, they're less likely to loan money to the government. And so then the government will have to incentivize you with a higher interest rate, a higher rate of return to justify your higher risk. So when you have a lower bond price, a lower price to loan money to the government, you have a higher interest rate. When you have lower interest rates, you have a higher bond price. So when you have a lot of people loaning money to the government doesn't need to offer a very high interest rate because everybody's loaning money to the government. But when people aren't loaning money to the government needs to rack up their interest rates to incentivize more people to loan money to the government. And this is where now it sets the baseline for mortgage rates. And the reason why is because this is the risk-free rate. And when people are worried about loaning money to the government and the government has to raise their interest rates, the investment that an investor has to make into the mortgage market has to be an even higher rate. Because it wouldn't make sense for you to get a lower rate of return when you lend your money into the mortgage market than if you lent your money to the government. Because if the government is giving you a higher rate of return, you'd want to put your money there because it's a risk-free investment versus for me to invest my money into the mortgage market to give somebody a mortgage, I need to get a better return for my risk. And the better return is a higher interest rate. So when you see these treasury yields fall, that gives more ability for mortgage rates to fall. When people are worried about inflation and treasury yields rise, mortgage rates will naturally have to rise as well because you have to compensate for the higher risk because I could just take my money and put it into the treasury market and get a risk-free return. So for me to take on more risk, I need a higher rate of return. This is why you want to keep your eyes on the Federal Reserve Bank because the more that the Federal Reserve Bank does to bring down inflation, the more that they're going to have to raise interest rates. The more that the Federal Reserve Bank raises interest rates, well, the higher pressure that's going to put on mortgage rates. Because now the Federal Reserve Bank and inflation both play an impact on what direction our mortgage rates go. And this brings us to the question of, what do you do? Should you be renting a home or should you be buying a home? Home ownership has been the American dream for as long as anyone can really remember because the whole idea is you can own a home and build generational wealth because you can pay down the home and then you can pass this home down to your kids and your grandkids and your great-grandkids. But I hate to break it to you, but your home is one of the worst tools to build generational wealth. Now, I'm not saying don't buy a home or that it's bad to buy a home. What I want you to understand is that sometimes buying a home is not the right answer for you. And what I want to do right now is talk about when it's better to buy a home, especially in this economic environment, and when is it good for you to actually rent a home. And there's a few different factors that you want to pay attention to. The first factor you want to pay attention to is, can you actually afford to buy a home? Number two is, do you have the savings to buy a home? Number three, do you have investments outside of your home? And number four, are you ready to buy a home? I want to talk about the second and third thing together, which is, do you have savings before you buy a home? And do you have investments to actually go on to buy a home? So I've talked about my 75, 15, 10 plan quite a bit on this channel. And what this means now is that for every dollar that you earn, 75 cents is the maximum that you can spend, 15 cents is the minimum that you're investing, 10 cents is the minimum that you're saving. That way now every time you make some money, some of your money's invested, some of your money's saved, and your mortgage payment is going to come out of here. Your mortgage is going to come out of your spending money. Now, in order for you to actually be able to afford the home, not only do you need enough money out of your spending fund to afford your mortgage, but you want to make sure you have a savings cushion and you want to make sure you have some investments too. Because if you don't have a savings cushion and you go out to buy a home and then the window breaks or the furnace stops working or the roof starts leaking, you need money to fix these things. Because when you're a tenant, well, now it's the landlord's duty to fix the AC, to fix the heater, to fix the roof, to fix the broken window. When it's your home, it's your responsibility and your bills that you got to pay. So you want to make sure you have a savings cushion. Now, a good savings cushion is going to be somewhere between 3 to 12 months worth of expenses, depending on how much risk you're willing to take on. So take on your monthly expenses, multiply it by 3, multiply it by 12. That's how much you want to save, not for your down payment, but in a separate savings cushion. That way you can protect yourself against an emergency like your window breaking. Your investments right here, this is what's going to make you wealthy. This is money that you want to make sure you continue putting aside for investments even after you buy a home, because this is what's going to make you actually wealthy. Not the mortgage. Look, your mortgage is coming out of your spending money. The spending money is what makes everybody else rich. This is the money you use to buy your car. This is the money you use to go on vacations. This is the money you use to go on to eat in restaurants. This is the money you use to buy your clothes. This is the money you use to go out and buy things. This makes other people rich. This makes you rich. This protects you against an emergency. Look at where your mortgage falls. Your mortgage falls here because your mortgage is making your banker richer. Sure, maybe you're using your mortgage to pay down the debt in your home and build some equity, but you're also paying a lot of interest to the bank. And I don't want you to mistake this mortgage or this home as an asset when it's only an asset if you can sell it for a profit. And you don't know that until you actually sell it. And there's a chance that you won't be able to sell it for a profit. So instead of hoping and praying that you're going to be able to sell your home for a profit, treat it like a liability and make sure you have money to invest. Where do you invest this money? Things like stocks, things like real estate, things like businesses. I like cash flow. That's why the majority of my investments pay me with cash flow. Things like my rental properties, things like my dividend-paying stocks, things like dividend-paying ETFs. If you want to learn more about how to invest your money, even if you don't have a ton of money to invest, we have a free ebook with Market Insiders, which goes over how you can start generating cash flow, how you can start investing your money, even if you don't have a ton of money, and how you can make your first investment. This ebook is completely free, and I'll link this ebook for you down in the description below. And the fourth thing that you want to pay attention to before you go and actually buy a home is, are you actually ready to buy a home? Because if you have a job that's unstable, or if you're moving city to city, or if you don't plan on being in an area for at least 2 years, then when you buy a home, you're locking yourself down. Now you might be thinking, well, if I buy this home, I can sell it in 6 months for a profit. Don't forget that when you go to sell your home, you're gonna have fees to pay. If you bring on a realtor, they're gonna charge you 6% in a commission. Then you have to pay the title agency, you might have to pay an attorney, you might have to pay a whole bunch of other costs to close and sell the home. So unless you can sell the home for 10% more, you're not gonna walk away with an additional penny. Not to mention all the other mortgage fees and stuff you had to pay in order to buy the home. So if you don't plan on being in that home for at least 2 years, you're not ready to go out and buy a home in this area, especially if you want to make money from the home that you're living in. Now again, I'm not saying go out and buy a home for the intention of making money, but think about it. If you're going to be investing into a home that you're going to be living in, you want to make sure that you're going to actually be there to enjoy the home. Now this is where a lot of people trash the idea of renting a home because they say, why in the world would you want to rent a home and pay this rental fee, but you're just throwing money in the garbage and you're just paying your landlord's mortgage, you're making your landlord richer. And I want to address that for a second, because if you wanted to go out and buy this home, let's just say it costs $500,000, that means you would have to put down $50,000, and then on top of the down payment, you're going to have to pay a mortgage. Now, if you wanted to just rent this home, now all you're going to have to do is pay a rental fee in order to live here and not pay that mortgage. But you don't build any equity in the home, you're just paying a fee. And I really like the way that my friend Ramit Sethi puts it, because what he says is, when you go out to eat at a nice restaurant, do you get upset and say, man, you're just paying the restaurant owner's mortgage, you're just paying the landlord's mortgage here? Or when you go to Chipotle, do you get upset and say, man, I'm just paying these employees' salaries? Because when you go and buy the Chipotle bowl, well, you're paying somebody and you're paying the owners to actually get that bowl. Anytime you pay for anything, whether it's a bowl at Chipotle, whether it's a meal at a restaurant, whether it's a belt at Gucci, it's making somebody else richer. That's the way that our economic system works. The more that you spend, the more that somebody else makes. But in exchange for you spending money, you should be getting some value. When you go out and rent a home, the value that you're getting is a home that you live in. But when you go to rent a home, you also don't have to go out and put down this down payment. You also don't have to take on all the risks of owning a home, because guess what? When you're a landlord, you also have your own risks, because tenants can damage properties. Tenants also might not pay, which means if you have to evict them, there's a lot of cost for that. Not to mention all the other expenses with managing a property, maintenance, your property management, your insurance, your property taxes, and everything else. So there are risks with being a landlord as well. But now when you go out and rent a home, you don't have to take this $50,000 and put it as a down payment into the property. You can keep this money, which means you can take this $50,000 and use it as a down payment to go out and buy a rental property. Or you can use this $50,000 to go out and start a business. Or you can take this $50,000 and use it to invest in somebody else's business. Or you can take this $50,000 and invest it into the stock market. So if you don't go out and buy a home, you still have the ability to build this type of generational wealth. It's just not in the home that you live in, but you can take that money and use it to go out and invest in something else, into a different asset that should or hopefully will go and grow. That way you can continue to see that money grow. But the key here is not just taking this $50,000 and leave it in your bank, it's putting that money to work, putting it into an asset. Because when you take this money and you put it into your home, you're using it as a down payment to get a mortgage, to buy a home, that way you can hopefully pay down this home. But you can also take that same $50,000 and put it somewhere else that's not your home. So if you don't go out and buy a home because you don't want to or you can't, it's not the end of the world. It's just now, what are you going to do with your money? That way you can continue to grow your money. The big question that a lot of people have right now is, in this economy today, should I go out and buy a home? Should I wait, or what should I do? And the key thing that I want you to understand about this economy, and really any economy, is that when I think about buying a home, I think about like buying a shirt. I don't care about making money from my shirt. Just like that, when I go out and buy a home, I want to make sure that I can afford it, period. If you can afford the home that you want to live in, remember that you're buying it to make memories, you're not buying it to make money. So now, if you can afford the home, you can afford the down payment, you can comfortably afford the monthly payment, and then you get a fixed rate mortgage, well, now you don't really have to worry, because then if mortgage rates continue to go up, it doesn't affect you. You got a fixed rate mortgage. If mortgage rates go down, well, then you can just refinance into a cheaper mortgage and save money on the monthly payments and put some more money towards your investments. That's not going to affect you either. If home prices go down, well, you're buying it for the long term and you can afford the monthly payments. If home prices go up, well, good news. You have some new invisible equity in your home. Don't go out and refinance and use that new invisible equity to go out and buy a car or a fancy vacation. Keep that money there and just continue making your payments, because when you buy a home, remember, this home, you're buying it like a liability, not like an asset. So treat it like that and use your money to go out and buy actual assets, things like rental properties, things like stocks, things like investments in other businesses or your own business. That way you can build real wealth, not just in the home that you live in, because, well, the worst kind of generational wealth that you can build is by paying down your home. This is great. It's not bad. I mean, it's better than not having any sort of generational wealth, but out of the spectrum of all the different types of generational wealth that you can have, this is the worst one that you can have. If you can build a rental property that will continue to pay cash flow long after you're gone, versus your home will be a money pit. Your home is a money pit until you sell it, and then when you sell it, you hope that you can sell it for a profit, versus a rental property pays you with cash flow. Stocks will hopefully have appreciation. They can also pay you with cash flow, and businesses, assuming you're investing in a good business, will be able to grow and continue to provide you with more value. That being said, I still know that many of you are sitting there thinking, okay, Jaspreet, that's great and all, but where are home prices going? So let's talk about that. Our April inflation report showed us that inflation came in cooler than expected. At the same time, we also saw that home prices surprisingly started to grow. And at the same time, we've also been seeing oil prices start to grow pretty significantly. The reason why these three things matter, especially in terms of the housing market, is because, for one, when you see inflation come in cooler than expected, that gives the Federal Reserve Bank less ammunition to continue raising interest rates. But when you see home prices come in hotter than expected, that gives the Federal Reserve Bank more ammunition to raise interest rates, because, well, like we were talking about in previous videos, in the CPI number, the inflation number, a third of the inflation is housing market affiliated. It's the shelter numbers, it's the owner's equivalent rent. So a third of our inflation number comes from the housing market. And now when we're seeing mortgage rates start to drop a little bit and home prices are starting to rise, you can bet that that's going to affect the inflation numbers in the coming months, which could give the Federal Reserve Bank more fuel to raise interest rates, especially later this year in 2023. And then third, we have the craziness happening in the oil market. And the reason why we're seeing this craziness in the oil market is because OPEC, these countries around the world that control the oil supply, unexpectedly came out and said that they're going to cut the supply of oil. When you cut the supply of oil without reducing the demand, it causes the price of oil to go up, which impacts things like gas prices and other energy prices. And the reason why that's significant when it comes to, well, the housing market is because when oil prices rise, the price of everything goes up. Because now when you want to get your groceries from the manufacturer to Walmart, or from the warehouse to the Amazon store to you, you got to pay for energy or gas to get the product from one place to the other. So higher oil prices cause the price of everything to rise. And the reason why that's significant is because when the prices of things are rising, that pushes inflation higher, which then could force the Federal Reserve Bank to take even more aggressive action to bring down inflation. So in the most recent report that we got, it said that inflation was cooler than expected. But now if you start to forecast what's going to happen next month and the month after that, if we continue to see mortgage rates at this kind of little slump, that's good news for somebody who wants to buy a home because now you can get a lower interest rate to go out and buy a home. But that could put more gas onto the Federal Reserve Bank to raise interest rates more aggressively. And if oil prices stay high, that again would put more fuel on the Federal Reserve Bank to raise interest rates more aggressively, which both impact the housing market. The second reason why this is so important to understand has again to do with the Federal Reserve Bank, but not because of interest rates. Instead, it's because of what the Federal Reserve Bank says might be coming later this year. So when the latest inflation report came out, we also got some other information from the Federal Reserve Bank directly, where they said that they are now predicting a recession by the end of 2023. Now, to just kind of clear the air, technically, by definition, we are not in a recession right now. That is the definition, because it's not been declared. However, the average American is already in a recession. So whether or not we're in a recession, I guess, is just a matter of semantics. The average American is already in a recession right now, but now we're having the Federal Reserve Bank saying that we are going to enter a technical recession by the end of the year, a recession by definition. Now, the reason why that's important to understand is because now we have to go back to the housing market. What impacts the price of a home? It's supply and demand. And one of the factors that impacts demand is mortgage rates. When you have higher mortgage rates, you have less demand. If mortgage rates jumped up to 10% or 12% tomorrow, you bet that there's going to be a lot less people going out to buy a home because that's going to make buying a home much less affordable. But the second aspect of the demand side of homes is the economy. Because when people are making less salaries, if people don't have a job, or if people don't feel like they're going to see the same upside in their company, they're going to be less likely to go out and buy a home because people want to go out and make big purchases when they feel like they're rich. When you feel like everything is going good, your stocks are rising, you're getting a promotion, you're getting bonuses, you're getting raises, people feel much more comfortable to buy a home. But when you're not seeing that, when you're seeing an economic slowdown, well, then that also reduces the demand. And so what we're seeing is that we're seeing more and more institutions, now the Federal Reserve Bank as well, who are saying that we're going to see more economic pain coming in 2023 and into 2024. Like what we've been saying here is that this economic craziness that we're going to see is not a 2023 thing. This is going to be a multi-year process, and it's going to take time because there's still a lot of excess cash in our economy. We have never seen this much money enter our economy that we've seen over the last few years, and it's going to take time for this money to disperse. But once that money gets dispersed, that's when we're going to really start to see more of the economic pain. Yeah, the average person has already started to feel economic pain because of the high inflation, but we haven't felt the real extent of the high inflation, and we haven't felt the real extent of the higher interest rates combined. We started to see a little glimpse of it when we saw a couple banks here in the United States collapse, like when Silicon Valley Bank collapsed, when Signature Bank collapsed. That was the start, but that also was protected because then we had the Federal Reserve Bank along with FDIC, along with the Treasury Secretary, Janet Yellen, come together to essentially protect all depositors, although the investors and the owners of these banks lost a lot of money. The depositors, which were safe, and that protected against a real mass panic and contagion in the banking sector. But this is we're now understanding higher interest rates are going to cause more economic pain. I've been talking about the debt crisis that we have going on because we have the highest amount of national debt, the highest amount of corporate debt, and the highest amount of household debt ever. And over the next 24 months, we're going to see a huge chunk of this debt readjust. Why? Because most corporate debt and most national debt, in fact, nearly all of this debt is not a 30-year fixed rate mortgage. Most of this debt readjusts every year, 2 years, or 5 years, or sometimes 10 years. And we're going to see a huge chunk, I think it's about half of this debt, especially the corporate debt, is going to readjust in the next 24 months. So now as the interest rate on this debt starts to readjust over the course of the next 24 months, that means the expenses that these companies and our government will have to pay are going to shoot up. And if the expenses rise for a company, but the revenue doesn't rise enough to meet the higher expenses, the company's going to have to make adjustments. They're going to have to cut their costs. Because if your costs are rising when your revenues are not, you're going to need to do something to maintain profitability. And that would mean more layoffs. And this, we're understanding all these different factors is so crucial as a financially savvy investor, because for the first time in the history of time, we have this publicly available information. Things like YouTube, things like podcast have made financial education and financial news more accessible than ever before, because prior to this, you only got what you saw on the Wall Street Journal or CNBC. And so now you have people, regular people, who have access to financial education and financial news. And so this is where things become very interesting, because the reality is there's a lot of red flags out there. And the most important thing for you to do is not to panic, it's just to be prepared. And being prepared means now understanding that, hey, there's red flags. Maybe nothing will happen, okay? Maybe everything will just blow over. But in case something bad does happen economically, how can you protect yourself? And the way that you can do that is by now living below your means. 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially prepared and financially sound, period. So take the income that you have right now, live below your means, pay down your credit card debt, get out of this financial hole that you're in, and then use the remainder income to build up a savings cushion so you have an emergency fund, and put aside some cash to take advantage of investment opportunities, and set up an investment system. Maybe you set up a passive investing system where you're doing something like dollar cost averaging your money into the stock market at the very least. If you want to get even more involved, well, then you can learn about how to invest your money. Now, if this is all kind of a foreign language to you, I have a free ebook that will walk you through how to start investing, how you can start generating cash flow, how you can start making your first investment, whether it's into the stock market or real estate market. It's a free ebook that you can read through Market Insiders. If you want to read this ebook on how you can start investing and start generating cash flow, I will link that ebook for you down in the description below. But this is where you have to start getting educated and aware of what's happening around you. That way you can take the best care of yourself and your family. Because the reality is, no institution, no government, no central bank is going to want to say that we have pain coming ahead. Because if anybody said that, what would happen? People would panic. They would freak out. When you saw the worries about the banking sector, people panicked. Everybody went to their local bank, pulled their money out. Some people put it under their mattress. Some people moved it to bigger banks. Some people used it to buy gold. People panicked. And this is where you have to understand that nobody wants to create panic, and you have a lot of people behind the scenes that are trying to protect us against major economic pain. But what you want to do is just understand, look, the range of opportunities and possibilities is, number one, we don't have anything bad happen. Number two, on this end, is we have major economic pain. Where will we be? Who knows? But this is, we're now understanding this range of opportunities and possibilities, and then saying, okay, if this is the range of options, I want to make sure I'm prepared for this and this. Most people live a life thinking, I don't think anything bad is going to happen, so I'm never going to prepare. And then when something bad happens, because the reality is recessions happen, they have happened about every decade forever now. It's a fact. That's why you see market crashes happen again and again and again. They happen every decade, and they still seem to blindside people. Understand that this does happen. Economic pain happens. But now, are you going to be prepared for it or not? That's why people who have an emergency fund can protect themselves from going into debt, because the reality is life happens. Emergency funds are not just there for theory. It's because people break their arms. It's because windows break. It's because furnaces break. It's because cars break down. And when this happens, when life happens, you need money to be able to pay this cost, because if you don't have the money, then you're going to have to go into debt to fix the problem, and then you have to go into a financial hole to then fix the problem. And now you have another problem to deal with. And so now, for you, this is where you want to understand, okay, there's a chance that we can have more financial pain coming. How do you protect yourself? How do you learn? How do you start investing? Then when it comes to the housing market, don't chase things. And this goes to every asset class, not just the housing market. If you want to buy a home or a rental property, fine. Make sure you can afford it. If it's a rental property, the analysis is completely different. When I invest in a rental property, I don't invest in a property based off of how much I think it's going to be worth in the future. I invest in a property based off of how much cash flow this property will generate for me. And if a property is going to generate me enough cash flow, well, that means I also have a buffer, that if I had to reduce rents or if we have some vacancies, I'm still going to be okay. Now you might say, but Jaspreet, where are you finding these types of deals? Yeah, you're going to have to be much pickier, because the reality is we have less inventory right now. Less inventory means you're going to have to be more picky. You're going to have to put in more work. It doesn't mean that you should never buy anything or should just completely sit on the sidelines, but understand and be pickier with your investments, because we have a lot of strange things happening right now. We still have high inflation. High inflation is making things more expensive, and it's continuing to cause pain in the economy. This is a fact. You cannot debate that because that is the reality of what's happening. We have high inflation. High inflation is slowing down the economy because it is reducing people's ability to spend, because people have to spend more money on necessary items. They have less money to spend on discretionary items. Fact. Second fact is, in order to bring down inflation, the Federal Reserve Bank is being forced to raise interest rates. Higher interest rates are also hurting the economy. Fact. The higher interest rates are making borrowing more expensive, which decreases spending. Fact. Higher interest rates are making past debts more expensive. Facts, which is increasing expenses for people through things like credit cards, because your credit card debt is not a fixed rate debt, it's a variable interest rate debt. So when interest rates go up, your credit card debt goes up. When interest rates go up, corporate debt goes up. When interest rates go up, servicing costs also go up. Now, what I want to remind you here is that market crashes and recessions create more millionaires than any other time, because that also means that assets go on sale. And most of the time when things go on sale, you see people freaking out because they're ready to buy. When Macy's has a sale on sweaters, you see a line around the block of people trying to buy that Macy's sweater. But when assets go on sale, like when you see the stock market crash, people panic, they sell, and they don't want to touch stocks. When you see a crash or pain in the real estate market, people sell, they panic, they run away, and they don't want to buy real estate. Now, this is where, if you are prepared, you will have the ability to then be able to capitalize on distressed assets if they come your way. But being prepared means, number one, you got to have access to money, because if you see a great investment opportunity but you have no money, you can't buy it. And second, you got to be educated, because you got to be able to actually find the opportunity. You got to know where to look. You got to know how to analyze the opportunity. We cover that in the Market Insider's ebook, but this is where now you have to start investing in your own education, start spending time to build your own education, and then also start researching. And then you also got to start putting the money aside that we have the ability to capitalize on opportunities, because there's a lot of emotion out there. And most traditional media is only in the business of selling emotion. And this is where I want you to start building that financial education. That way you understand, okay, let's look at this practically. Market crashes happen. They have happened in the past, and they will continue to happen. We have a lot of red flags in our economy right now. So what can I do? I can be prepared. I can be financially educated. That way I can capitalize on whatever opportunities that come my way. And even if nothing bad happens, well, I just have a big bank account, and then I can go to Disney World. So this is where it pays to be financially educated. That way, if something bad does happen, you don't get smacked by it, and you can capitalize on it. But it starts with you understanding what's going on. In 2023, when France announced that they wanted to raise the retirement age when you can start collecting government benefits from 62 to 64, people rioted. They protested, but the bill continued through the government. Also in 2023, Argentina passed a law making it easier for their citizens to fund their retirement by